The S&P 500 hit 7,000 for the first time this week, then immediately reversed. Microsoft crashed 10% in a single session. The Fed paused rate cuts while nominating a hawk as the next chair. If you think this is just normal market noise, you're missing the deeper pattern unfolding. This is exploitable because human psychology is creating systematic mispricing that disciplined investors can recognize and position against. Markets entered this week with classic pre-event euphoria. Traders positioned ahead of Magnificent Seven earnings and the Fed meeting with elevated volume and bullish sentiment. The VIX barely moved despite the anticipation. This is textbook crowd behavior, leaning forward instead of stepping back when uncertainty should demand caution. Tuesday's healthcare massacre revealed the fragility beneath that calm surface. United Health plunged 19% on Medicare rate changes. Humana dropped 20%, yet the S&P still closed at a record. This divergence exposes compartmentalization, investors tolerating massive sector shocks while clinging to the broader growth narrative. The crowd refuses to connect policy risk to portfolio risk. Wednesday brought the psychological milestone of 7,000, triggering immediate profit-taking. Humans anchor to round numbers predictably. The intraday rejection wasn't about Fed policy or earnings, it was about exhaustion at a symbolic threshold. The market had reached its target and needed permission to retreat. Thursday crystallized the deeper anxiety. Microsoft's collapse on slowing cloud growth isn't about one quarter. It's about the market finally questioning whether AI spending will ever generate proportional returns. This is the first crack in the consensus that justified stretched valuations for 2 years. When Meta surged 9% the same day Microsoft crashed, it showed the market is now differentiating within the Magnificent Seven rather than treating them as a monolith. Friday's Warsh nomination introduced Fed chair uncertainty. The initial sell-off followed by recovery revealed relief masquerading as optimism. Markets prefer a predictable hawk to an unknown quantity, but the subsequent close lower showed that relief was shallow. Higher yields and a firmer dollar represent the cost of capital rising in real time. The system is exhibiting classic late-cycle characteristics: narrow leadership, elevated valuations, and increasing sensitivity to marginal policy changes. The S&P printing new highs while the Dow fell 400 points isn't broad strength, it's concentration risk disguised as resilience. The Fed's hold was unanimous in outcome but fractured in reasoning. Two dissents advocating for cuts reveal a committee no longer aligned on risk balance. The removal of language about labor market risks being asymmetric is a hawkish tilt disguised as neutrality. Futures now price 2 cuts by year-end, down from 3 at January's start. December jobs data underpinned Fed caution. 50,000 jobs added is weak, but unemployment dropping to 4.4% signals stabilization, not crisis. This removes urgency for cuts while keeping inflation concerns alive. The Fed is trapped between a labor market that won't collapse and inflation that won't cooperate. Earnings reveal dangerous bifurcation. Aggregate S&P growth of 9% is solid but not exceptional. The problem is pricing for exceptional outcomes. Microsoft's crash on cloud deceleration is valuation reset, not fundamental collapse. The stock assumed perpetual acceleration. When growth merely slows, multiples compress violently. Healthcare's policy-driven collapse warns that political risk isn't priced. When administrative decisions can erase $100 billion in sector market cap instantly, the assumption of stability becomes fiction. If policy can do this to mature healthcare companies, no sector is immune. The Stoic approach recognizes 3 critical truths. First, concentration is fragility. When Microsoft can drag the entire index down in one session, you don't have diversification, you have a house of cards. Second, policy is no longer a tailwind. The Fed's pause is actually a pivot toward hawkishness. Third, the crowd is exhausted. Breadth is narrowing, volume spikes meet reversals, and round numbers trigger profit-taking instead of breakouts. The market now operates where good news becomes bad news. Strong earnings lead to valuation compression. Weak jobs remove rate cut urgency. The system is priced for Goldilocks scenarios, while deviation from that script triggers volatility. This isn't a market climbing a wall of worry anymore. It's balancing on a knife's edge of complacency. The discipline lies in recognizing when irrationality has peaked, not predicting when it begins. The market can remain irrational longer than most can remain solvent, but complacency always corrects eventually. If you value systematic thinking over emotional noise, subscribe for frameworks that exploit predictable human behavior. Download the complete Stoic exploiter methodology in the description because markets reward discipline, not hope.